and welcome to the market update for Tuesday, October the 25th. If you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to jerry@traderspro.com. Really didn't get a lot of questions over the last week, so I've got time set aside to answer questions. So if you have them, make sure you send them to me. I'll be happy to answer them for you. All right, let's get started. Obviously, the market's been rallying a little bit over the last few days. We're going to take a look at that and take a look at how much longer we think that'll last. I will say that I think it's temporary. I think we're getting pretty close to getting another move down. I'll show you both arguments that you can make right here. But before we get to that, though, the direction alerts, still in a bear market. Now the momentum, the indicators, the directional indicators have all moved to a kind of a neutral area right in the middle. We have momentum right here in the hold range. What does that mean? Well, it means that the market could rally a little bit further. It's not overbought. Overbought is this area over here. So there is potential for the market to rally further if it wants to. But there's also It's also not oversold, which is this area right here, which means that we're in almost a perfect position here to start another move down, where we could have a bigger move down and it could last for a little while. Drops tend to not last very long because the markets tend to fall a lot faster than they rise. But there's room for it to have a bigger move down from this area right here, this neutral area right here, or even if it's slightly overbought. It has a long way to go before it becomes extremely oversold, which is where you would maybe expect that trend could, or that drop could end or start to end. Again, these indicators we're looking for extremes. When we're in the middle right here, this is basically saying we can go either way. And so then we're going to be looking at our charts to see what the trend behavior is and where that direction is most likely to be. Okay, and then where we would also know if we're wrong or if the market is deciding to go in a different direction. How are we going to know that the market hasn't bottomed out and that it's starting a new uptrend? What are the things we would look for? Well, some of them are pretty obvious. I've talked about it in almost every class. We're still kind of waiting for that panic sell-off to take place. It hasn't happened yet. But we'll take a look at with some different possibilities when we get to the charts. Market breadth is in the middle too, in the trending range. It's not overbought nor not oversold. So this is saying is that market could go either way right here. And then the sentiment indicators move back into the extreme complacency range. We did temporarily get into the high range when the VIX was moving higher. But that's VIX has come back down. VIX has actually come back down below 30 today. It's the first time it's been below 30 for a little while, and so we'll take a look at that chart here in just a second. All right. So, but as far as the indicator here, could it become even more complacent? Yeah, we could still move towards the far right side of the extreme range. If the market does start to sell off in a big way, if it starts selling off in a big way, I think this would be the time we finally see that sentiment indicator at least get into the trending range, maybe even the fear range if it starts dropping sharp enough. Part of the reason why, one of the things that I'm kind of going back and forth on is, a lot of the charts are indicating that we could have a bigger drop. Obviously you've been hearing me talk about the, market bottoms tend to have these panic sell-offs. But what has really concerned me for a while now is that there seems to be a lot of people that are looking for the same thing, that are waiting for the same thing. There's a big portion of the market right now that's bearish, and you typically don't get panic selling when the market is already bearish. I mean, you remember, panic is an emotion of not knowing what's going on. If you think of just any time of your life where you've panicked, it's irrational. It's not thought out. It's reactionary. It's something has driven that extreme emotion. If everyone's, again, thinking the market could go down, they're either selling or they've already sold. It's going to be hard for the market to keep dropping. Now you say, well, couldn't that be what creates a bottom and then we start rallying off of that? Well, again, I've talked about this before, but it's been a while since I've talked about it, that what could happen is we could start to get a rally that maybe it starts to turn people more bullish. They think that maybe we have bottomed and this is it, and they start getting more aggressive. And then you get the bigger panic sell-off later on after those people, because that would create panic. People think it's over. People think it's safe to get in and start buying, and they're confident that they're getting in at the bottom. They're being maybe even more aggressive than they normally would, because, boy, if this is the bottom, I'm going all in. This is the one time in my life where I'm going to pick the bottom and be right and profit tons from it. And then the market rolls over and they realize, oh crap, I just put everything in. Yeah, that could create panic selling. So these are just some things that I'm not saying that we're going to be able to use this as a what's going to happen tomorrow or what's going to happen over the next week type of indicator. But anyone that studied Elliott wave analysis, one of the big parts of Elliott wave analysis is human nature and human emotion that plays into these decisions of why we buy and why we sell. And actually, what we think are random decisions that we're making are actually very predictable. We all tend to sell at the same time. Why? Well, because we're seeing the same data and we're reacting to it, and we think we're just doing it individually, but actually collectively as a group, we're all doing the same thing. And that's why it always seems, that's why very often you wonder, you start to feel like the market does the opposite of what you think it's going to do, because you're very often in that situation, you're being reactionary. You're just trading off of emotion, and the market's going to do the opposite of that most of the time. So but the bottom line is, what I'm trying to look for are reasons why the market would go lower, or what would create that panic selling. And I'm finding a hard time seeing that. Now, it could also be triggered by an event. I remember what really triggered the selling in 2000. Remember, the market was dropping at the end of 2007 and going into 2008. We didn't get the big crash until September of 2008, the financial collapse. Remember, Lehman Brothers went under, I think it was April or May of that year, and people kept saying, "Oh, it was just that bank. It's not going to affect everyone else. Don't overreact." And it wasn't until it looked like everybody was going to go under that the whole financial infrastructure of the country was going to be destroyed, that it triggered the real panic selling. So could it be, I'm not saying it's going to be related to the banks, but could it be something in the financial structure that, could rattle the economy? Could it be something like that could trigger panic selling? Yeah, it could. And we're definitely in a vulnerable spot right now. Where if you got news out that again, I'm trying not to think it's going to be the same thing, because it usually isn't the same thing. So I'm not necessarily looking at the banks as being the what's in trouble, and for the most part, the banks seem to be in pretty good shape. But is there something else in the side? Could it be related to the bond market that causes fear that would lead to panic selling? I don't know, but that's something that could trigger it. Now, obviously, that's something we can't spend nights awake on, because it's unknown. We don't know anything yet, but just be aware that there could be something like that hits. And if the market is already in a vulnerable spot where it looks like it could go lower, and then you get a clear reason to sell, yeah, that could create panic selling. So anyway, those are just some of the things I've been thinking about. And again, I'm not trying to suggest that we can use that as a near-term predictor, but very often when the charts get in certain situations, there's a trigger that causes the move to start, whether it's up or down. And sometimes when I see the chart in a pretty critical spot, I start looking for triggers or paying attention for triggers that could be the reason. Remember, people need reasons to buy and reasons to sell. That's what CNBC makes its living on. The market's up today. Why is it up today? And so all day long, people are talking about why it's up, and they'll point to this reason, or they'll all agree on one reason. It's like Apple's earnings could be good, and that's why the market's up today. Well, what if Amazon's earnings are bad the next day? Why is the market up again if Amazon's earnings are bad? Trying to find reasons that are consistent or that always make sense is kind of a joke as well. Technical traders joke about this all the time, because it's like, I remember way back when had the first early days of the war in Iraq, and the market was down that day because of the war in Iraq. Well, the next day the market would be up, and it'd be like, wait, isn't there still a war in Iraq? Why isn't that the reason? So these reasons can be very ridiculous, but nonetheless, that's human nature to come up with these reasons. And so that's why you don't want to be trading off of the reasons that you hear all day long. But if the reasons line up with what the charts are doing, then it's not a bad way to go. As long as you're not, again, basing your decision on everyone's collective reason of the day, so to speak. All right, so let's go back to buy-sell ratios have come closer together. They're not showing any sort of extreme. In fact, just the opposite, that we could go either way from this position here. And our other sentiment indicators right in the middle. So again, it's about as neutral as you can be either way. All right, so let's take a look at the charts. Let's go into the S&P chart. And I am going to look at the different indexes, because there are some differences here that we need to kind of pay attention to. Now, one of the things that we were talking about last week, I think last Thursday, the market had been dropping. We had this bearish reversal candle on Tuesday, and remember that whenever you see that bearish type reversal, that there's a high probability that you're going to get at least some move down. Well, we did. We got 2 days where we dropped a little bit lower. One thing I was noticing, and it really kind of hit me in class as we were analyzing. If you remember back on Thursday, you can go back and review the recording of it. But one thing that I was noticing was that the VIX was up and the market was, the VIX was down and the market was down and the VIX was down. That's what it was I was noticing. And it didn't make a lot of sense, because if this was getting ready to drop in a big way, the VIX would be rising. It'd be going the opposite direction. Anytime the VIX and the market are moving in the same direction, you always want to pay attention. If the market is up and the VIX is up, it usually means that people are buying, the professional traders are buying, but they're also hedging. They don't trust the rally. Now, it doesn't mean the rally can't keep going, because over the last 2 days, on Friday, most of the day, the market was up and the VIX was up. At the very end of the day, the VIX moved down. So you had that relationship at the very end of the day where the market was up and the VIX was down, which is a normal relationship. But it happened like in the last 15 minutes of the day that the VIX dropped. Yesterday, we had the market up again, and the VIX closed up. It was up as well. So what was that telling me over the last couple of days? It was telling me that the people were buying, but they weren't trusting the rally, and so they were hedging. They were still buying those protective puts along with buying their stocks. Well, did that mean that the market was going to drop immediately? No, today we're up again. And actually today we're up and the VIX is down a pretty decent amount. But I look at those 2 days, Thursday or Friday and Monday, is okay, is that a warning? Is that warning me that we could be getting close to a drop or reversal? Now, again, I'd never make a trade based on that alone, but I tuck a clue like that away in my mind and say, okay, this is what was happening. Let's see if we start to see any bearish reversal price action here in the next day or two, and maybe that was foreshadowing it, that behavior. Now, but the opposite was happening on Thursday, where we had the market was down and the VIX was down. Now, if this, like I said, I had a bearish reversal candle. It could that signal that we were having our next move down? Again, the last Thursday we were back. We were pretty much all week last week. We were in a position where we could go either way, right? That was the big theme of the week was, hey, I could make an equal argument why we could go up or go down. Well, when I noticed that the VIX was down and the market was down, I'm saying, okay, wait a second here, this doesn't make sense. So that is telling me that the professional traders aren't too worried about the drop. Okay. Well, if they're not worried about the drop, then it could mean that maybe the market is going to rally, that we're not going to drop right here. And you can see the price behavior this day as well. Let me zoom into a 3-month chart so we can see this in a little bit more detail. So this is what happened on Thursday. We tried to rally all the way up here. So the buyers were trying to push things higher, then the sellers pushed things all the way back down. We're about to close at the lows of the day. That seems like that was a pretty decent bearish reversal right there. Sellers taking control and closing the market near the lows of the day. Then why is the VIX down? The VIX should have been going up, and it wasn't. And so after class, I started to look at that and say, man, this is looking more and more like the market could rally. Now, again, I wasn't going to be buying anything on that because there wasn't any confirmation that the market could rally. But I definitely didn't want to be short. I actually had some put option trades I was in that I got out of because I'm like, this is actually looking like it's less likely we're going to go down and more likely we're going to rally. I don't want to be in put options if the market rallies. Sure enough, you had that Friday move that confirmed that. And it also then over the last couple of days has confirmed one of the possible patterns that we were talking about. Because last week I mentioned that this could be a correction and we could head lower right from there. But it's also possible this is wave A, this is wave B, and then you get one more move up for wave C, and then you drop. I think that's what we're getting right here is that kind of an ABC. Now, if you go back, let's go back to a 6-month chart right here. If you're going off of, pure Elliott wave, you've got wave 1, wave 2, wave 3, wave 4, wave 5, and then this looks like wave A, B, C. Now, there's a couple things to look at right here or to watch out for. One of the things I always look for in ABC patterns is that very often the ABC pattern will complete when wave C is about the same length as wave A. Now, the key word there is about. It doesn't have to be exactly the same length. It can be a little bit longer, a little bit shorter, but it'll have a look of being about the same length as wave A. Well, we're right at that point right now where wave C and A look about the same distance there, okay? Now, would I go short, the market based off of what I'm seeing right here? Well, this is just the opposite of what I was seeing on Thursday. No, I wouldn't just go short the market right here because there's no confirmation of that except for, hey, this is a possible bearish ABC pattern and it could start to drop, okay? But I can start looking. I could wait to see if I see some sort of bearish reversal candle. What happens if we get a candle like this tomorrow? Let's say the market, it's likely the market's going to close near the highs or where they're at right now. It could fade a little bit into the close. If it faded a lot, that could maybe be a bearish indicator. It came all the way back down and closed down in here. That could be the bearish reversal signal that you're looking for. But what happens if maybe we gap up a little bit tomorrow and then we close lower than where we opened, but still higher than the day before? So we could have another up day, but it could show a momentum shift like we saw last Tuesday. Okay, I think that was I'm pretty sure that was last Tuesday. I think that's what we talked about in that market update class last week. If we did get something like that, yeah, I might trade. Definitely as far as the portfolio, I'd be getting into the SOXS and the SARK to hedge the portfolio. But what I'd be looking for right now is do I see any sort of bearish reversal in the price action? Now it could be that we could open slightly higher or even lower and close below today's low. That would be a bearish reversal candle. Anything that would move or close below the low of the previous day right here would be a pretty bearish price action. Okay. Now, like I said, it's not likely it's not likely to form today, but this is what I'd be looking for the next couple of days: is do we see that show up? And maybe it doesn't. Because the bullish argument you could probably make in the very near term is could this be a inverse head and shoulders pattern right here? We talked a little bit about this last week. That is that possible? This could be a bullish inverse head and shoulders pattern. Yeah, it could be. Now it's important to remember that not every inverse head and shoulders pattern works. We trade it all the time. Does that mean that none of the trades we've gotten into have ever lost us money? No, none of these patterns work 100% of the time. And it did move up off of this pattern. So could it be both yeah, that's an inverse head and shoulders pattern, but could it also be that if we got a bearish reversal candle, that it could also mean that that's done and we drop again? By the way, here was a bullish ABC pattern back here. See, again, notice when wave C was about the same length as wave A. And then it took off. That's one of those relationships you kind of look for. And you could make the argument that here was a bullish reversal candle right there. Add a second one right here. It was possibly signaling that. We don't have the signal yet of it reversing, but could it be that this is going to lead to a much bigger move higher? It's possible. Okay. Now, the key areas that you want to be looking at, well, first of all, I think I don't know if I pointed this out last week or not, but we were sitting right at this is not going to be a straight line, but do the best I can here. Actually, that's not a straight line because it would, where we closed yesterday was right at that trend line. So that's probably more likely the line right there. Okay. So that was something I was looking at yesterday was, hey, we're right at a trend line. We could possibly reverse right there. Although if this was wave C right here, it wasn't very much, it looked much shorter than wave A. So I wasn't sure if that was going to hold, but with today's move, it makes it look more like that. It's in proportion with that pattern, that possible bearish ABC pattern. Now, we don't, I have another charting service where I analyze some other things. One of them is the 50-day moving average. I'll use that sometimes. This is a different software, so it's not going to, we're not going to be looking at MACD, RSI, or any of these other technical indicators because this is a trend. This is a trend following software. It's going to be a signal type software, so it's basically designed to do the work So the average person just doesn't want to learn that stuff, doesn't want to deal with learning any of that stuff, can just, hey, is it have the buy signal, sell signal, overbought, oversold, designed to keep it pretty simple. But the 50-day, for those of you that are interested in trying to find some other possible resistance areas, the 50-day moving average, I think, is at about 386, I think. So right about in here. I think that's worth noting because, you know, if tomorrow we do gap up to around 386 and you see a reversal of some sort, that, you know, that could explain maybe why it's reversing. Maybe it punches through it. The probably the biggest area that I really want you to pay attention to is this 389. There's major support resistance at 389. It comes from this area through here. You've got support through here, resistance, support, resistance. If we break above 389, then we have to turn a little bit more bullish on the markets, at least in the near term at that point, because it's significant, especially if it blows right through it. I don't think it would blow right through it, but if it does, then you've got to pay attention to that. Okay. Remember the importance of technical analysis is you can't get married to a position or an outlook or what have you. You have to be flexible. Because again, the problem with technical analysis, and this is what people bring up all the time that argue against it, is that, well, if you have a bias that's strong enough, you can make any chart look like the market's going to go up or go down, or it's about to go up or about to go down. I mean, you can basically find reasons why it could go in the other direction. You could have somebody that gives you 10 reasons off the same chart why that stock should go up, and another guy could give you 10 reasons why it's going to go down. And that's true. If you bring in a strong enough bias into your analysis, you can do that. And so you have to fight against that. And one of the ways that you see me do that is forcing myself to look at other possibilities. Okay, right now I have a bearish bias. I still think this market is heading lower. Now it's not without evidence. Okay, obviously the trend is down. We're in a bear market. The trend is down, lower highs, lower lows. But also, Fed's raising rates. You don't want to fight the Fed. The market is headed towards a recession. We're not even technically in a recession yet, but we're headed there. So you can have reasons for it, but I got to be able to say, okay, well, what would turn me bullish? What would force me to have to rethink that analysis? Well, if we start getting above 389, especially if you start to get another pullback and a move higher, now you're dealing with higher highs, higher lows. Remember, an ABC pattern will look like, a bearish ABC pattern. You have a strong downward move, and you get a bearish ABC pattern. A bearish ABC pattern will show you a temporary, it will temporarily act like an uptrend, meaning that you'll get a higher high, higher low right here. And it'll usually happen right when you're about to have that next move down, right? But if you were to pull back a little bit and then go higher again, and now you have multiple higher highs, higher lows, well, you got to pay attention to that. It just still might not mean that you're in a trend reversal. Sometimes these corrections can be choppy and sideways for a little while, and they could give you higher highs, higher lows, but they're slightly higher highs and higher lows. They're real choppy looking, more sideways looking. But again, if you are acting like an uptrend, if we get a really big move up, and then we break above that 389 area, and then you get a pullback, and then you rally up again. I mean, it's hard for me to now look at this as being corrective when it looks almost straight up at that point. This is what happened in this area right into here. kind of the same thing, is that we had this big drop. We had what looked like wave A, wave B, wave C. We had the market start to move down right here, and I thought, okay, this looks like we're heading lower. We're starting the next move down. What happened? We suddenly rallied back up. Now you're looking at higher highs, higher lows, and now you have to say, hey, we're actually in an uptrend. Again, it looked like a temporary uptrend, but you had to respect the fact that it was now acting like an uptrend. Okay. Now, again, we resume the decline again. Could we be getting the same thing happening right here? It's possible. But if you go back to this area right here, after we started to move down, then we blew higher again, I started to turn more bullish, at least to the near term. Hey, we're in a near-term uptrend. And again, I didn't trust it, but we traded it. We added some positions to the portfolio, things like that. And so in case it was going to last longer, and we'll do the same thing here if this continues to move up. So again, I'm not trying to be Johnny Psychic here and have my prediction come true. In fact, just the opposite. If it starts to behave differently, I got to be Johnny Flip Flopper if it starts to look more like it's going to continue to go higher. We can take a look at the Russell 2000 here in a second. Some of these charts they're showing some different things that we need to pay attention to. I don't think anything is going to make me turn more bullish on the market today. And I'm not going to get into moving averages any more than I already have, just because we're trying to stick to the current software we're analyzing right here. But the main chart you always want to start with is the S&P 500. It's going to be the most accurate reflection of the market, because you're dealing with 500 of the largest companies. The largest companies are going to tend to be the main trend of the market. The Dow is only 30 stocks, so you can get, and we have seen a difference. We'll take a look at that here in a second. The Dow is behaving differently than the S&P. And then you have the tech sector with the NASDAQ that's more focused on that sector, on the tech sector. Not that every stock is a tech stock, but the majority in the NASDAQ are tend to be tech stocks. And then you have the Russell 2000, which is including a lot of small companies. That could be an indication of risk on or risk off type behavior that could be helpful in your analysis. But you want to start with the S&P chart and then take a look at what the others are showing you. All right, so those would be the two possible outcomes here, I think, out of this. Could it be, like I said, could this be bearish ABC pattern that's about to complete and then we'll start to move lower? Or is it inverse head and shoulders pattern? We start moving up above 386, 389. That would turn us a little bit more bullish if that were to happen. Now let's take a look at the Dow chart, because the Dow has been outperforming the other indexes by a pretty large margin. And you can see right here that it's moved up a lot further. So if you're going to call this wave A, wave B, wave C, you've got a situation where that wave C is a lot longer than wave A. Now that can happen, where wave C is a little bit longer than wave A, although that's a lot longer. That's almost twice as long as wave A. Could it be, though, that, well, even if you were to, it could be that this was the correction and this was the bottom of the trend, and this is A, B, C, and that would put your wave C a little bit more in line with or your wave C a little bit more in line with wave A. But the point is that this has had a much higher rally compared to that S&P chart. And it would make sense. I mean, you know, the Dow, these are the 30 largest companies representing different sectors in the economy. And so what you're seeing is, you know, professional traders that are trying to make some sort of return this year they're going into companies that aren't gonna disappear on them. You know, they could still go down, but in many cases they have higher dividends, so they're trying to capture some return through dividends, things like that. But what's going to be interesting here is that the Dow Industrials are not, the Dow Transports are not confirming what the Dow Industrials are doing. Now, normally this relationship doesn't, you know, when we're looking at the Dow Transports and the Dow Industrials, it's not telling us too much on a weekly basis. But when there is a divergence that's pretty noticeable, that's when you want to pay attention. And the divergence right now is pretty noticeable. And I'll pull that in when we'll look at these two charts again when we pull up the transports. NASDAQ 100, obviously it's been really underperforming, but this is another thing to look at is the chip stocks compared to the NASDAQ 100. The chip stocks are really underperforming as well. And so, again, you're not going to base a trade on that alone, but it is leaning more towards the idea that this is of a bearish ABC pattern, bearish correction of the downtrend. This looks a lot like the S&P chart. You know, 1, 2, 3, 4, 5 waves down, ABC. But again, possible inverse head and shoulders pattern could be developing there. This one also kind of broke the trend line of this decline. Recently, it broke above that trend line. And then here's the Russell 2000 chart. Now, the Russell 2000 chart doesn't look bullish at all. I mean, look at this right here. What's basic trend analysis 101? Stocks will tend to alternate between impulsive and corrective moves. Impulsive is a sharp move in a direction. Corrective is more choppy, more sideways. When you're in a downtrend, you get impulsive down, and then your rallies tend to be more choppy, more sideways. That's what that looks like right here. You got impulsive down and just choppy. Now you could say, well, we're getting higher highs and higher lows. Yeah, but this was an example of what I was pointing out earlier, which is it's barely higher highs and higher lows, and the fact that it's more choppy and more sideways. Now, again, all we're talking about here when I talk about trend analysis 101 is we're talking about trying to read the probabilities. What is the probability? Is it possible that the Russell 2000 rallies up straight from here? Yeah, we've seen it happen before. But the probability based off of basic trend analysis is that you're more likely to, when the sideways move is done, you're more likely to resume the previous trend. Whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. We had an upward move, started to move sideways, more likely it was going to move up. Again, not always. We had a sideways move, where was it? I think it's been a little while now. Where was it? It happened. Anyway, I'm on the Russell chart. That's why it's on the S&P chart. Right here. You went back and heard my updates from back in here. I said, well, it's moving sideways. The previous move was up. It's more likely that we're going to continue to move up, and we didn't. And you say, well, see, it didn't work. Well, for every time it doesn't work, you're probably going to see it work about 80% of the time. So from a probability standpoint, you want to lean towards the 20% of the time it doesn't work, or the 80% of the time where it does work. And again, I don't know the exact percentages. I'm just throwing out a example of, hey, most of the time it's going to behave that way. You're going to move in the direction of the trend previous to that sideways move. But that's anything I talk about in class. There's always going to be nothing is absolute, and we can't know exactly what the market's going to do. Everything we do is going to be based on probabilities. And as you'll notice, with each of these things we look at, we're trying to see how many probabilities, analyzing different charts and different indexes, how many probabilities are pointing to a move up or a move down, or like last week where there was no strong probability in either direction. It could go either way. It's important to recognize that behavior as well. Oh, so shoot, I had the thing on pause. I'm sorry about that. Let me go back. I'll just briefly review this. This was the Dow chart back here. Again, it's moved up proportionally much higher than the S&P chart and NASDAQ chart, any of the other charts. So there's been an overperformance of the Dow Industrials versus the other markets. We're going to come back to this chart when we look at the industrials here, or the transports. NASDAQ 100 looks very similar to the S&P chart, so we're not spending too much time on that one. And then the Russell chart. This is what I was talking about. And again, choppy, sluggish as it's moving higher. Previous move was down, had a pulse of down, choppy back up. All right. Bond market was, boy, it was stretched, and you're not going to see it here because it rebounded pretty sharply today. But at the lows down here, we were at the extreme oversold area right here. We were right at the left side of that box. And today's rally was strong enough to push it all the way out of that extreme area there. Now, what'll probably happen is I don't think that we're going to be getting a trend reversal yet in bonds. We definitely can't come to that conclusion on one day where it rallied off of an extremely oversold condition. But one thing you'd look for is, this would be considered it was a gap up right here, but that's considered an impulsive move up from the lows. If it starts moving more choppy for a couple days and then has another move up, you start looking at, or if it starts moving up sharply over a few days where this looks impulsive down, impulsive up. Remember, a market bottom, you alternate between impulsive and corrective moves, and very often at a trend reversal, you'll get impulsive down, impulsive up, and then the pullback will be corrective, and that can indicate that maybe you're reversing trends. So what you look for is you have another day or two where we come back, and then when it pulls back, is it more choppy, more sideways? That could be an indication of potential trend reversal. But yeah, and I'd have to assume that this trend has been underway for quite a while. Are we closer to the bottom than the top? Probably, but again, I'm not trying to pick the bottom in bonds either. I wouldn't be surprised though if we see the bond market rally ahead of the stock market. I mean, the stock market might have another move down or a bigger move down as the bond market is already starting to recover or start to move back up. But we can take a look at a longer term chart here. Yeah, you can see the last 2 years we've been seeing a steady decline in bonds. And so we're not trying to predict when that'll reverse, but that's a pretty big jump today. Bond yields come way down relative to what they were on Monday. So we'll have to see if that sparks anything here. Remember, though, one thing I would point out, though, is remember all that volume that was coming in. I went through that, I think it was last week or whatever, maybe it was a week before, but there was tons of volume coming in right here earlier in the month. And I was assuming it's buy volume, and it still could be. When people start buying heavily, it doesn't necessarily mean it's the end of the drop. Look at the volume from Friday, though. Look at that massive bond volume buying. Somebody, and it had to be somebody big, and probably multiple people that were big. There was heavy volume in all these bond ETFs. And so we'll see. Maybe that is kind of marking a bottom, and maybe we'll see a more sustained rally in bonds. That's what I thought back here. And you had a bullish hammer formation and everything, all this volume right in here, and then look, it really dropped extreme before having this extreme reversal move. So we'll see if this does, have any sort of sustained rally. It could be about to just do something like it did back here, where again it rallied, but it was more choppy. It was basically a correction setting up for another bigger move down. Could the same thing happen here? That's possible. Gold had a big bounce on Friday. Now, a lot of this was driven by the dollar as well. Remember, commodities and the dollar tend to move in the opposite direction. A stronger dollar tends to be bearish for gold and silver and oil and different commodities. A weaker dollar tends to be more bullish for those commodities. You've seen the dollar pull back a little bit recently. So what I'd be looking for with the gold chart here is that going to be a higher low? It's a slightly higher low. Does that hold? We were focusing on that back here as well. It didn't hold. It dropped even lower from there. Is this going to hold, or does it go to a lower low? It's a very slightly higher low. In fact, it's probably close enough where you just call this, see if this is a double bottom, and then it rallies off of that. I don't see anything here that would make me really strongly bullish in gold. Here's a critical area right here. That would be the area, if it gets above there, that would give you a higher high. You could have a higher low, slightly higher low right here. If it rallies back up here, you'd have a higher high. It would look more like a base. It could look more like it could be basing for a reversal at that point. But from where it's at right now, you just assume that downtrend is going to continue until you saw a little bit more evidence of a potential trend reversal there. Here's an oil chart. Now, oil has been a little bit sluggish the last few days. Haven't gone anywhere for the last week, basically. But this is still a higher low as of right now, and it's kind of lined up with this other previous. So we talked about the potential inverse head and shoulders pattern right here. This went to a higher high, but since then we haven't done a whole lot. But again, until we start seeing it on the chart that it's not going to rally, there's still enough reasons there to believe that oil should go higher. And I mentioned this on Thursday. It could start to move very dramatically, just because I was joking on Thursday that it was 70 degrees outside and where I live. And I told you that we were expecting a storm on the weekend. Well, we got snow dumped on us big time over the weekend. It went from 70 degrees to 40 degrees, By the way, if you want a vacation to Utah for snowing, we got the ski resorts are probably going to open early this year, because there's a ton of snow up there. I went up there I went for a drive on Sunday, and my kids all went my kids all ski and snowboard and stuff, and the resorts aren't open, but they hiked up the hill and had a ball over the weekend. But the point I was making on Thursday is that we're going to see that dramatically shift into cold weather. We've already seen it in some areas of the country have been in, have these cold snaps. And we're not really thinking the demand for oil is going to be increasing so much in our country. Again, it's Europe, as the supplies with Russia have been cut off for the most part. That's going to be possibly the big driver of oil going higher. And it could be helped if the dollar continues to move lower, which it has been. Although I still think the way the dollar chart is looking, that this is just an ABC correction, ABC, and then it should resume higher after that. But we'll see we'll see how it looks if it gets down into this area right here. There's a lot of support in this area here. If it starts breaking below that, if it starts acting like a downtrend where you get a move down and it's sluggish on its rallies and then drops, sluggish on its rallies, it could be potential trend reversal there. But this kind of weakness in the dollar so far is at least holding up. Now, we just haven't seen oil. Oil didn't rally. It's been moving sideways for the most part. Gold rallied a little bit, I think, a lot on that drop in the dollar. But that's something to keep an eye on. There's typically an inverse relationship, not always, but typically an inverse relationship with the dollar and commodities. We'll keep an eye on that. And the VIX, you can see a big move down the VIX. I'll bring in my other chart here to look at the VIX. And I want to point out a couple things here. So let's see. So this was what I was seeing on Thursday. The market was down, but the VIX was down. The VIX was down a ton, and it was right at 30. It was looking like it was going to dip below 30. That made me feel like there's no fear in this recent drop. We could rally off of that. We did. And then what we had is the opposite on Friday and Monday, where we had, here we had the VIX. Again, it's going to be compared to, widen this out a little bit. So we had for most of the day, we had compared to this low right here, that's where we closed on Thursday, but the VIX was up and the market was up. Right in the last 15 minutes was when this slid back down and went lower. So we did get the market up, VIX down, which is a normal relationship. But then look what happened yesterday. Here's where we closed on Friday. The market was up and the VIX was up, and the VIX closed up from Friday. Again, you don't want to base a trade on that alone, but it was telling us that maybe don't trust the rally as much. And obviously, this is why we don't trust it alone, as the market did rally higher today and the VIX has come down. We're down well below 30 now. So that would be a signal to be a little bit more bullish. Where it could be a little bit more bullish is the fact that the VIX is down below 30. Now, if it spikes back up above 30 with any sort of selling, then that would really could be a real strong signal that we're going to have a bigger move down. So that's something to kind of keep an eye on. And there could be a little bit of support. You could make an argument that there's a little bit of support right in here. But again, if we're closing at the lows of the day, I don't see anything in that would cause me to be bearish. And that fits right in line with my other analysis. I don't see I'm looking for some sort of bearish reversal in this area because there's resistance. It looks like a bearish ABC pattern on the SPY and things like that. But I don't see anything yet. I'm not just going to guess that we're going to turn around and just go down from here. All right, now let's take a look at the chip stocks. Again, look how sluggish the rally has been on the chip stocks. Yes, they've rallied, but they're kind of underperforming. And typically we're going to be looking at comparing the chip stocks to the NASDAQ 100. So let's type in the Qs right here. You can see that there's been the NASDAQ 100 has outperformed the chip stocks. It's rallied stronger than the chip stocks. Remember, the chip stocks should be a leading indicator. So if this is a real strong rally in tech stocks, the chips should be leading the way, and they're not. In fact, take a look at the chart of AMD to find just a large, big mover of the chip index, one of the biggest chip stocks out there. Look at that underperformance. I mean, it's up today, but look at that. If you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. Now, again, do you base a trade off of divergence like that alone? No, you don't, but you tuck that away and say, hey, I don't trust this rally because the chip stock should be leading the way. Now, the other one we'd look at too is the transports. Like the transports, choppy, sideways. Now compare that to the Dow Industrials, the DIA. Look at that. The Dow Industrials are outperforming the transports. It shouldn't be that way. The transports should be the leading indicator. Now, again, most of the time, it's not showing us anything, or it's slightly better or slightly worse. But this is a pretty strong divergence. This is pretty obvious. This is really obvious. Dow is not only outperforming the transports, it's outperforming the other indexes. So we'll keep an eye on that. We'll see if that is significant. But yeah, that's a pretty distinct difference there. Now, by the way, if you don't, this is based on Dow theory. If you want to Google Dow theory, there's much more in-depth explanations of that comparison that you can find out there. The idea is that the transportation stocks, they're moving products around the country. If they're doing really well, it usually means the economy is doing really well, and it usually means that if the transportation stocks are doing well, the industrial stocks will follow. If they start to show weakness or they start to underperform, that it could be a signal that the economy is slowing down or isn't as strong, and that we could start to see it show up on the industrials. Now, there's a lot of people that will argue against it. The people that argue against Dow theory, they're arguing against people saying it always works or it's an absolute indicator. Nobody's ever said that we're going to base a trade on that divergence alone, but over the years it's worked very well in warning of not to trust a rally or to trust a rally when you see the transports outperforming the industrials. That's why I still use it. Now, again, you'll never hear me say my entire trade is going to be based off of that divergence. But we're going to tuck this away and we're going to see if this ends up predicting another move down, or forecasting is a better word, another move down. Bitcoin did a little bit of a spike move today, but it's another one that has been just kind of flatlining, and the longer term chart would suggest that it has another move down. and this isn't even as we're using this as a proxy to Bitcoin stock to look at. Actually, the Bitcoin chart. Actually, I can pull up a Bitcoin chart. The reason why we can't have an actual Bitcoin chart is because you can't. These are Bitcoin itself is on different exchanges. It's not if you're going to trade Bitcoin on the New York Stock Exchange or the Nasdaq or whatever, it's going to be either a ETF that's somehow related to it, or these companies that are basically holding companies for Bitcoin. But anyway, I kind of just throw that on there for those people that are trading crypto. High yield corporate bonds, we've been kind of watching this chart again, very similar to what we're seeing in the other charts. We're sluggish right through here. It has rallied for the last couple of days. We're waiting to see if this gets any sort of bearish reversal, but shows a move down. All right. So again, what's our conclusion after the analysis? That still possible it could move up a little bit further, but we're looking for, at least over the next couple of days, I would say this week, because it could be a few days, but we're looking for see if we get any sort of bearish reversal, or if we break out above these levels I talked about, 386, 389. 389 would be the big one. We might have to turn a little bit more bullish. So where we're at right now, I don't see a reason to hedge the portfolio. So I'm not going to have SOXS or SARK in there. If we get a bearish reversal candle either tomorrow or Thursday, then I may at least get one of them. Maybe I don't go in with both, but I go in with one at least. So if you see any sort of bearish reversal candle, now what would be a bearish reversal candle? I would say something like what happened last Thursday, where we open higher and we close lower for the day, but higher than the day before. That's a bearish reversal. Or if we open higher and close lower than today, that would be that'd be a bearish engulfing candle. That'd be a bearish reversal signal. Or if we open lower and close below today's low, that's a bearish reversal candle as well. That could indicate a start of a move down. That maybe that is the completion of the bearish ABC pattern. And if I see that, then I'm probably going to hedge. Like I said, I don't know if I'll hedge with both. I might hedge with both if it's that strong of a bearish reversal candle. If it's kind of iffy, meaning that maybe you open lower and you traded all the way down here, but then you came back up and you closed lower for the day, but you have kind of a tail to the candle there. Maybe I'll just hedge with one of those ETFs instead of both, and then I can always add the second one if it starts to move down. And then, do I really want to add anything here? I don't, just because, like I said, I'm waiting to see if this bearish scenario plays out. And if it doesn't, then if we start breaking above these levels, then by Thursday we might be above these levels, and I might be jumping into more trades. I already have bullish trades though, so I don't see a reason to increase that risk dramatically just yet. Now, I will point out that I did get out of NOC, but I'll probably be looking to get back in it again when it pulls back. I got out of this one yesterday because yesterday we had a bearish, this is what we call a shooting star candlestick formation. It opened right here, traded all the way up here, then closed lower than where it opened, but still higher than the day before. That was showing that we should go down today. At least all that's showing short term is we should have gone down today, which we did. We opened down here. Now, with the market going higher, people did step up and buy, and it looks like it's going to close higher than where it opened. But boy, this thing hit the far right side of the extreme reversal risk. And this was yesterday. It's backed off because today it opened lower. but I see a bearish shooting star, far right side of the extreme reversal risk, and the possible bearish ABC pattern in the market forming. I'm like, okay, I'm taking profits on this one. Now, in a normal bull market, I might be not worried about these little pullbacks because I don't want to be trying to jump in and out of things. But there's a high probability we're going to get some sort of pullback today. I was like, take the gains. I have some nice gains on this. And it did. It opened lower, did what that candle said it could do. And now the candle this could just be buyers trying to push things back up again, but you're already still in the extreme reversal risk. I would be surprised if this starts to pull back again. And so that's what I'm waiting for. Let's see if it pulls back. Now the risk there is, could it just take off and go? And I wish I would have stayed in it. Yeah, that's happened before. But I'm going to wait for this, see if this thing can pull back a little bit, maybe get another entry point in. But I want to get back in. I'm very bullish on those defensive stocks, as I've told you before. I decided to go ahead and take profits on that. And I didn't add anything new. I don't plan to add anything new today. So let's take a look at the portfolio as where we're at right now. LNG, this is our natural gas, down a little bit last couple of days, but it's kind of a side. It's trying to break out. So that's what happens sometimes when it's trying to break out. It'll move sideways along here and then break out. My stop's all the way down here, so I'm going to let that one. I gave that plenty of room because I'm pretty bullish on the energy stocks. Like I said, I'll hedge it if we drop. I'll be jumping in with those inverse ETFs to hedge it a little bit. Marathon Petroleum, again, a little sluggish in the last couple of days, but overall the trend is still there. My stop, I think, is down here, so it's like plenty of room for that one to go to. Archer Daniel Midland up today. Again, nothing in there. We are bumping up against some resistance. So could we move sideways a little bit and consolidate before breaking out? Could just punch through too. No reason to get out of that one. Now, well, one thing to keep an eye on is that we are in the extreme reversal risk on here, but we're not the far right side. But if we had a big up day and we broke out, that I consider taking. Well, I wouldn't just get out because you had a big up day and because but what was the difference between this one and NOC was I had a bearish reversal candle and I was extremely oversold or overbought, excuse me. And yeah, I might get out of that. If I saw bearish, if we gapped up above here and then closed lower than where we opened, and that pushed us to the right side there, yeah, I'd probably just jump out of ADM at that point. I could always get back in because maybe what'll happen is it broke out and then it's going to come back and retest the breakout, come back down under here and then take off again. I'm just going over a couple things here because these are decisions I might make in the middle day and Wednesday. Maybe I do something like that. And if you're seeing some of the stuff I'm explaining right here, maybe if you're trying to follow along with these trades, maybe you make some decisions in your trading based off of that. I really don't see anything big happening before our Thursday update, but in case something happens tomorrow, that's what I'd be looking at is if there is some sort of bearish reversal candle. But I wouldn't be jumping out of these just because we have a bearish reversal candle in the market, though. I'd be hedging. I'd probably just hedge with those inverse ETFs. These charts still look pretty good. Tech, again, had a big move on Friday out of that sideways range. No reason to get out of that one. CEIX has come down. This is our coal trade. A little bit of a bullish candle today. You can make an argument this is a deeper bullish ABC pattern. My stop's down below here, so I still have a little bit of room to let this thing work its way back up. There was a question there. Let's see this. Let me finish up with the CF again. This is another fertilizer trade, but it's a consumer staples type trade. But this one still looks pretty bullish. Potential inverse head and shoulders pattern right here. We break out of this, we should run. There's a question on LNG. That it had a hold signal in a short-term downtrend. Remember, I have to keep repeating this, but remember what I keep saying. This is a trend following software, but the trend following, what the trend software is saying right now is be out of the market for the most part. We're in a bear market, we're in a bearish trend. The safest place to be right now is out. Don't be in anything. But if I get into class each week and say, we're in cash again this week, I would have been saying that for the last 3 months and we wouldn't have done it, and no one would show up to class. It would be a waste of time. So remember what I said. I said, we're in a bear market, safest place to be in cash, but we're going to do something. We're going to try to just trade this environment, and we're going to do some things that we don't normally do. We're going to be jumping in and out of things. We're going to hedge with inverse ETFs, which I'm not going to be doing in a bull market, at least not very often. We're basing a lot of our trades off of the chart patterns. What we're doing here, for the most part, what we've been doing is we've been saying, okay, we're in a bear market. What is the only thing that's really working in this bear market? Energy stocks, a little bit aerospace, consumer staples. Okay, we're getting into trades in these sectors because these are the stronger sectors within this crappy market right now. And so we're trying to just squeak out some sort of gain. And for the most part, we're up to 136,000. We were at 133,000 a week or two ago. We made $3,000 in a market that's, bear market conditions, and for the most part been trending down. We're just trying to grind out some gains and do some trades while we're waiting for the market to bottom. So this is stuff that you're not normally going to do. And I promise you want to see how the normal, like I said, if you want to see how the normal class is going to be like when we bottomed out, we start moving up, go look at a market update from 2 years ago or something like that. You go to YouTube and review one, and you'll see exactly the process I kind of go through, and it'll be a better reflection of how we're using the software. Okay, because it really is great. It's a trend following software, but the trend is down right now, and unless you want to be shorting things, which is I don't recommend, especially if you're a newer trader, you can get a big trouble shorting stocks. Then the safest place is to be in cash or trade the strongest sectors. Okay. And what I'm looking at on CEIX is this was a correction here, move higher, move here. We got into CEIX somewhere in this area right here when it looked like it's moving up. It's dipped down a little bit. Remember, my stop's down here. So you're talking about what the signals are telling you right now, but that's not what we were looking at when I got in. We got in over here. I put my stop down below here, so this is where I know I'm wrong. If we dip down below there, I'm going to be stopping out. Could you get out just because the short-term trend is down and now it's flashing a sell signal? Yeah, you could. You can do whatever you want. You can manage it however you want. And I'm not saying the way I'm managing it is the perfect way to manage it. But that was the wiggle room I was willing to give it to work its way higher. And again, part of my thesis in this is just, like I said, I believe that energy is going to take off again going into the winter. I wanted to have exposure to natural gas, to coal, and to oil. And that's what I'm holding right now. And if I'm wrong, no big deal. You know, hopefully I'll make it up with some of the other trades, or if the market starts really dropping right here, I'll make it up with those inverse ETF trades. Yeah, so that's the answer. I'm just doing things a little bit different right now because of the conditions. Otherwise, I wouldn't be doing anything. And you wouldn't want to tune in each week because it'd be boring. But as you'll notice, what I've been saying all along, though, is I've been saying this is not an area where you want to be loading up. You don't want to be, we don't want to have all of our portfolio in the market. So even though we're getting into some things, look at how much of my portfolio is in trades. About 3/4 of it is not. It's in cash. And like I said, all I'm trying to do is just squeak out some gains right now. Let's see if we can get to 140,000 in the next week or two, while we're waiting for this market to bottom. All right. Just to give a couple of stocks again, if you're looking for something that looks like a decent pattern, I'm just going to go under the new buys today. We'll look at other sectors on Thursday in the stock specific class. But this Regeneron, REGN, 93 strength rank. Again, I had the big move up right here, corrective, broke out here. This is kind of corrective. Looks like it could be in another impulsive move up. You could put a stop down below here or a stop down below here. Probably this would be the better one because you cover both lows, give it a little bit of room to go. This one's outperforming. The market's been going down, and this has been trending up. And then another one off of that new buy list was this RS, Reliance Steel and Aluminum Company, 93 strength rank. And again, I like this move up. This looks like your correction. And then you have a smaller impulsive move up, smaller corrective move here, and you've gone to a buy signal. It looks like it can be breaking out right there. You could put a stop down below here to give it plenty of room. All right. That's all I have. Any other questions I didn't get to, make sure you email those to me. I'll be happy to answer those during the week. Or, even if you need a better, if you want to be more specific with your questions on CEIX or something like that maybe I didn't cover, or maybe I misunderstood the question, send me an email. I'll be happy to spend a little bit more time with you on that, explain that, or hear a little bit more from your end of what you're wondering. So, like I said, I haven't gotten many emails over the last couple of weeks, so I've got time to do it if you want to send it. All right, have a great week, everyone. We'll see you on Thursday for the stock specific class. Bye now.